What's going on, everybody? Happy Friday! It's Friday. We have made it to the end of yet another week. I thought it would be super important to do one more technical analysis video. This time, excuse me, this time to kind of go over market structure, accumulation, distribution, the whole market cycle. And then within that market structure, show you how the master pattern works. Okay, it's contraction, it's expansion lines, and then it's the trend phase. So they're very similar, those two. Okay, the market structure, master pattern, but there's kind of a unique way I like to use both of those in order to find good technical levels to possibly buy or sell something, so long as the fundamentals and the sentiment all look good. So just think of trading as just one gigantic puzzle. That's really all it is. I mean, think of an airplane pilot. They have to go through a big long checklist of things that they've got to double check, triple check in order for everything to come out good so that they can take off on a flight, right? That's really the same thing as trading. It's just one big puzzle. You gotta fit all the pieces together. But this, in my opinion, is really uh, the foundation of technical analysis. This is a 30,000 foot view of just strictly technical analysis, and it's all about understanding the market structure. So you can go to alphatrends.net. You can see right there the @ sign, alphatrends.net, and you can find this same diagram that I've got here. But I just want to read through this and kind of pick apart a few of these uh, highlighted points, and then I'll show you how I'll kind of compare and contrast it with the master pattern, and I'll show you some examples on a chart. So yeah, let's just take a look. I mean, we've really got four stages, as you can see at the top. Stage one, okay, accumulation. We got markup, we got distribution, then we got decline. If we kind of look into this bottom part from the start of this, we got 1 1 1 2 1 3. So yeah, just like it says. So early accumulation, we got an early, a mid, and a late accumulation. So the beginning of transition from bearish trend to more neutral, longer moving averages, they're still declining, and the stock, which it says stock, but just you can picture that as gold price, forex price, metals, cryptocurrency. Just think of all the different assets that you probably trade, and just think of that. Okay, this isn't just for stocks. This is for everything. So yeah, as it says there, longer term moving averages, they're still declining. The assets will cross above and below these moving averages. Many of these stocks will continue lower and should continue to be monitored for short opportunities. So get rid of my gum real quick. So yeah, I mean it's basically to the end of that downtrend. There are still some opportunities, but once you've gotten way too far away from the origin of that strong move, the management, I mean let's just say the probabilities go down, right? And we'll just like it shows on here. I mean, this is the bottom. This is what we're talking about, but you see price goes up from there. So this is just talking about the end of the downtrend. Okay, if I go over to my chart just to show you what I'm talking about, dollar Swiss. I tried to find something that would closely resembled this, right? So if I do this, see how that's pretty well the same as far as the line, the price line, compared to dollar Swiss franc, pretty well the same. So what I mean by the end of the downtrend, so look, let's just zoom out, and you see that this was a downtrend going down into this consolidation point. So this consolidation point right here is the same as this right here. So I'm basically talking about the end of the downtrend, the previous downtrend, which set up the first bit of accumulation. So yeah, this is where we're at. So that's what we're talking about. Yeah, just zoom back in here. Mid accumulation, bearish forces become more neutral as buyers methodically accumulate shares, but still no signs of upward momentum develop. So basically, this is where the big banks and institutions start buying positions. Because remember, it wasn't a downtrend. They are completely stalling that because they're starting to buy into the strength of the short sellers, the retail sellers, or other maybe institutions that don't do as good, right? So basically, there's as the price is going down, they're starting to buy. They're starting to buy little bits, just little bits at a time to smoothen out that price. Because at the bottom, we got the buyers and the sellers that are just fighting each other. Nobody's winning. They've stopped the downtrend, but it has not yet went up. So that's what this accumulation phase is all about. And then, like it says at the late accumulation, higher lows will often develop, but the stock is unable to penetrate a longer term resistance level to create that higher high. Moving averages have flattened out as buyers slowly gain control. So little do the short sellers know it, but the buyers have already won this race. And you'll start to see that when we get over to the markup phase. But that's what it's all about. So big banks and institutions, well, actually, if I just go back to my chart. So remember, this was a downtrend, right? From this point up here down to here, the buyers, the big banks, they started stepping in right here and just accumulate. They don't want to put $100 million, buy long on this right away, because if they do, the price will skyrocket too quick and they won't get all their order filled. So they're just buying little bits. And then once they've finally accumulated all they want, then that's where they can manipulate price. And that's where the master pattern comes in. And I'll show you a little more about that later. So yeah, stage 2, just like it says here, we got the markup. Okay, bullish phase of a stock. A stock's life is defined by higher highs and higher lows. This is where you want to get long on breakouts and after short-term pullbacks. Rallies are innocent until proven guilty. So this is where buy low, sell high comes into effect. But we've got to see some manipulation first. So like it says at the bottom, stock first establishes a pattern of higher highs and higher lows above rising longer-term moving averages. I'm not a huge moving average person, but moving averages are definitely, especially for beginners, a very, very simple way to see if you're going up or down. So, but anyway, just to finish this, these stocks show considerable upside momentum and should be monitored closely on short-term time frames for low-risk buying opportunities. This is where the multi-time frame analysis comes in. If you're looking at the curve, like I talked about in video 3 of my technical analysis video, go see that if you haven't. If we're looking at the weekly time frame, we want to see where price is in relation to the most recent accumulation phase and the most recent distribution phase. Okay, we got to buy low, sell high, so we want to buy on the lower end of that. Remember the Hungarian flag example? Okay, the bottom of the Hungarian flag is green. The top of the Hungarian flag is red. That's where we want to do all of our action. And in the center of that flag is white. That's no-going. That's diddling in the middle. We want to stay the heck away from it. So when we're looking for the master pattern, which I'll explain shortly, we're looking for that right in this area. Okay, if I zoom all the way out, we're looking at it in this area. This is after the breakout of the accumulation phase when the buyers start to take control and move price up. So this spot right here, okay, the bull, if you look at the picture of the bull there, the bull's leg, right? That's where we want to start looking for buy points. To finish up markup here, pullbacks above the rising, let's zoom in. Pullbacks above the rising longer-term averages may become deeper. These stocks are often in the sweet spot of an uptrend where gains come quickly. So this is where the buy low, sell high comes in on the smaller time frames. In my case, I like to look at trend on a daily time frame. I like to go down to 4-hour demand zones to find a price retracement on that smaller time frame in order to scoop up a position with anticipation that it's going to keep going up. The late markup, the upward momentum is still present, but rallies may take longer to develop after pullbacks. Gains can come very quickly, often at the expense of trapped short sellers who have incorrectly bet against the trend. So remember, the short sellers already had success at pushing trend down. They look at the accumulation phase as just a little battle between the buyers and the sellers. They ultimately think that if price goes up, then they can get a cheaper price to sell into, and then they're gonna add to their sells. Well, as they're doing that, that's where the big banks and retail traders that know what the hell they're doing, That's where they say, thank you, I'll take those shares so that I can push price up. It's called a what the heck's the term? Yeah, whatever the term is. But yeah, you basically suck in the shorts and smoke them fools. Squeeze, short squeeze. Okay, that's really what this is all about. This phase right here. All right, so price goes up, the markup phase. This is the trend phase. But then price starts to go sideways again. That's the distribution phase. So this bottom over here was accumulation. This is now distribution, what you see in yellow here. So 3, 1, 3, 2, 3, 3. Let's read into that. Distribution occurs after a prolonged price advance process of sellers starting to gain control of prices, which leads to a decline. So this is the prelude before the drop. Okay, if we dig into that a little deeper, early distribution, shorter term moving averages begin to cross one another, indicating a confusion of trend. So hey, what the heck? Price was going up. Why did it stop going up? This is where the buyers and the sellers start fighting again. Many of these stocks will continue higher, so they should still be monitored for potential long candidates. Well, yeah, that's true. I mean, you could still do that, but look how far price is compared to where price was. Okay, wholesale prices down here, retail prices up here. It's too expensive to buy. It's overbought. You hear overbought and oversold a lot. Okay, down here was oversold because remember we had a previous downtrend, so it's oversold. Prices reversed, went up. Now they're up high. They're overbought. So prices just are like the diagram shows here. Up, up. We got a high point. We got a higher low, and then we got a higher high. And then over here, if you look at the downtrend, it's just everything in reverse. We got a high point. We got a low. We got a lower high, and then we got a lower low. So this is just the cycle. It's the way the market works. Back to distribution. 3-2. These stocks have become more neutral and should be looked at as correcting through time. Upside is still possible, but becomes less likely as the interest from momentum traders shifts to more active issues. So again, it's retail. We're now in retail pricing. So yeah, you can still, some people can still, on some smaller time frames, get some long trades, make some profits. But if you're looking at it from a higher time frame, it's overbought. You want to just hang out and wait and see what the big banks do. Where do they push the price? And then late distribution. Some of the shorter term moving averages may be declining and acting as resistance, but the stock has not yet broken key support to place an official downtrend. These stocks are quite vulnerable to decline. So yeah, I mean, price is going sideways like you see right here. You got this low point, you got this high point, and then all the price action is just going right straight in the middle. Okay, so buyers and sellers having a dog fight, right? The bulls and the bears having this arm wrestling match. Who's going to win? All right, well, let's find out, because now we get to stage 4, the decline. So this is now the bearish phase of a stock's life. This is where you want to short, look to sell short, fresh breakdowns after short-term rallies have exhausted themselves. Rally attempts are guilty until proven innocent. So now we're flipping everything. Okay, let's go read through that. Early decline. The stock first establishes a pattern of lower highs and lows below the declining longer-term moving averages. These stocks are beginning to show signs of fear and can decline rapidly. These stocks should be on watch list for short sale opportunities. So we got to be careful on when to sell something. We gotta have it prove itself. Like it says, it's guilty till proven innocent. I think it said up top here. Is that what it said? Yeah, guilty until proven innocent. So this is where fake outs come in. Okay, the banks like to fake people out. They like to collect liquidity, which I'll show on the master pattern shortly. Mid-decline rallies to longer-term moving averages typically fail as more participants lose hope in a rally and the reality of a declining stock starts to settle in. These stocks offer excellent shorting opportunities. Look, price is clearly going down. If there were buyers up top, they're now getting their stop losses hit. All right, and they're losing money because they're on the wrong side of the trade. And then to finish it out, late decline down here, the downward momentum is still present, and declines can come rapidly, but so too can violent short squeeze rallies, particularly after bad news is reported. So that's just a little bit about the market structure. But yeah, if we go back over to my chart, I mean, basically that's it. We had a downtrend and then price evened out. All right. So basically what we've done is created this little, this bit of price action right here. If I just kind of do this. All right. So you just see everything is within that green box, right? So that's the accumulation. And then now we've got the markup phase after price broke out above the top of the box. Came up to here. Now price is going sideways again. If we take a look at our box here. Come on. Take that all the way over. Okay, there's our distribution. And then after price breaks out of that box to the downside, now we go down, and then the process just starts all over again. All over again, right? So price is down here. It's now forming another box, just like that. Okay? Now, from where current price is, now this is my daily chart, so every candle represents 1 day's worth of price action, price range, okay? So yeah, so we're currently in another, well, it's a contraction point, but do we yet know if this is an accumulation, meaning it's going to go up, or if it's a distribution and going to go down? This could be a continuation. It could keep going down. We don't know that. We don't really know until we get some manipulation from the big banks, and they'll determine where price goes based off where liquidity is. So yeah, I mean, you know, it could very easily, I'll just kind of zoom out here. Yeah, I mean, once price leaves, that price could leave up and go up. We don't know. What if price comes down to the bottom of the box and leaves from the bottom, right, and goes down? We don't know that yet. We don't know that until we start seeing some manipulation, until we see a master pattern form. What's a master pattern? Okay, fine, I'll show you. Let me take a drink of water. So, if I reset my chart and I get rid of all my drawings, in fact, yeah, the best thing for me to do is just to turn on my master pattern indicator. So what I'm going to do is go down to a 4-hour time frame. If you use TradingView, which by the way, it's the best trading platform I've ever seen, you can actually go to your indicators button and type in master pattern indicator. I got a lot of them that I follow, but yeah, master pattern right there, which I've got it on my screen already. So if I just flip that on, this is now going to show me something that looks very similar to accumulation and distribution, the market structures that I just went over. But now I'm looking at this on a smaller time frame. Well, first of all, if I go over to, what was my currency pair? Aussie dollar, Canada dollar, this will be the best way I can use as an example. So if I go to my daily time frame, okay, what's that look like? What do these boxes look like? Well, those are accumulation points. Those are points of contraction. The lingo is just a little different in master pattern, but it's very, very similar to the market structure I've already shown. We're basically looking at points in time, and I'm back to my daily time frame. Points in time where the buyers and the sellers were fighting. Okay, the price is contracted into small boxes. This indicator just happens to do it for me. But yeah, you can see over here, I mean, price went sideways, and then price moved out and went up and then down, right? Same thing here. Price went sideways. Well, let's start over. Accumulation. So the buyers ended up winning. Why? Because price went up. Okay, price did come back down because the shorts stepped back in. And then price came back up and it accumulated once more. Price went sideways. This time, The sellers won. So price went down. Okay, the buyers started stepping in, pushed price up. The shorts said, nah, B, we're going back down. And then we get into another accumulation area, another contraction point. So as you can see from this point, the sellers won this battle for a moment. The buyers stepped in, moved price back up, still within that box, but then the shorts stepped in and pushed it all the way back down again, creating lower lows. Price bounced up, contracted again. The buyers and the sellers got into a dogfight. Who's going to win? Well, it looks like the short sellers won. But then the buyers stepped in, moved price up. The short stepped in and pushed price all the way down. So that was a pretty good battle that the short sellers won. Buyers stepped in, pushed price up. We get another contraction point. Basically, what I'm saying is that this process repeats all day, every day, in every market, in every single time frame. Doesn't matter if you're looking at a monthly chart, daily chart, 5-minute chart, 1-minute chart. Okay, it happens in every time frame and every asset. So if we're looking at a daily time frame, the most recent price, well, we've got a contraction point here. Price kind of went out, and it's basically made some higher highs if I zoom in on it a little further. Now, Aussie Canada dollar, I'm paying attention to longs only because my edge finder, if I look at the Aussie Canada dollar, where's it at? It's at the very top, I think. Yeah, look at that, Aussie Canada dollar. I've got a bullish score of a 7 because of my sentiment, because of my economic data. A lot of blue boxes, a lot more blue boxes than red boxes. That means that the Aussie dollar had much better reports come out than the Canada dollar for those blue boxes, and then vice versa. The Canada dollar had worse or had better reporting on the red boxes. So if you add that all up, I got a positive score of a 7. Anything over 5 is a bullish. So I want to try to find a long trade for the Aussie Canada dollar. Well, if I go back over here, I'm going to because of my fundamentals and my sentiment, I'm going to assume price is going to go up. Well, if we look at our contraction point for a daily time frame, we can see price has broken up. It's broken up through the box. So now I want to go down to a 4-hour time frame, and I'll find a demand zone. Okay, I found one right here. Look at this. On a shorter time frame. Oh, hold on a second. Let's do this. Get rid of all my drawings. Yeah, I see a demand zone right here. So I'm going to mark a rectangle there. I want price to come down where I could potentially buy for price to go up. Now, the way the master pattern works is something called contraction, expansion, trend. So if we look at this blue box just as an example, price contracted, price expanded out to the top, so the institutions pushed it up. Okay, they want to see what kind of volume that they get. They want to see how many buyers step in to potentially move price. If they don't get enough volume, then what they'll do is collect this volume to the left. See this high point here? People that sold here put their stop losses up here. So at this point, they're collecting whatever stop losses are here, whatever liquidity. Okay. Plus you got this low point over here further back in time. So yeah, there's short seller. There's stop losses in this area. So they want to collect that and push price down. As they're pushing price down, you can see this little line form above. Why is that there? Okay. They push price down. The retail short sellers step in as well. So they're putting their stop loss up here. That's what that line represents, liquidity. So price comes down below this box. Banks want to see how much liquidity is down here. Okay. So that they can take that liquidity, those stop losses, these stop losses down here from retail traders, because they placed a buy order, they're putting in a sell order here. So the banks need to accumulate buy orders. Well, how do they do that? By buying a sell order. So when price comes down here, they collect this liquidity, these sell orders, so that they can buy. Opposite of a sell order is a buy order. Banks need sell orders down here to take the other end of it to buy. So they do that and they push price up. Now they've come up and they've collected this liquidity. Okay, these are stop losses. If they shorted in here, these orders up here are buy orders. Big banks can now take those buy orders and use them as shorts to push price back down. So this just continues, and it continues sometimes for a few legs, a few contraction legs, sometimes several. But ultimately, what they're doing is this. Okay, they're taking volume up here. They're taking these stop loss orders. They're taking stop loss orders down here. They're taking stop loss orders back up in this area again. Okay. And the process just keeps going. I mean, the price came back down. Now they're, see this line here, they're taking all that liquidity right there. And currently we're up here. So this could go on for another couple legs or so. We don't know. But ultimately what's going to happen is price is going, as long as price goes in the way of the economics and the sentiment, price is going to keep going up. So this is where I would want to buy right here. Okay, I want to see price. I'd like to see price come higher first. Okay, close up here before it comes back down to my demand zone to where I could buy for a profit, potential profit. Nothing's guaranteed. But basically, the master pattern, this is where the banks are collecting liquidity to make their ultimate move. Now, this is a smaller time frame because if I go to a daily, you can see I got my box, I got everything going sideways. So within this, you know, within this daily contraction point or accumulation point, that's where I want to go down to my smaller time frames. And then I like to even go down to a 1 hour time frame, right? So now let's look at that same box. See all the blue boxes? Those are called major contraction boxes. Why? Because price went out of those boxes below and above it. That's where the banks are collecting their liquidity. They're planning. They're plotting and planning in here. They're accumulating, and they're going to look and ultimately see, do we have a lot more sellers, retail sellers? Do we have a lot more buyers? Okay, and this is where retail sentiment comes in. They're going to be paying attention to that. Do they think the Australian Canada dollar pair is going to go down? Well, it all hinges on how much activity the retail traders have already done. They want to find these pockets of liquidity to be able to fuel the big ass trade that they're doing. Because remember, they can't just get in and out of a trade like that. They're doing millions, hundreds of millions of dollars on these trades. So they've got to play this game of cat and mouse. They've got to send price down here to collect this liquidity. They got to send price up here to collect this liquidity, this liquidity, this liquidity. And then ultimately, once they've accumulated all the shares they want to accumulate within this overall, remember, daily contraction box, if we zoom back out, once they've accumulated all the shares they want, then they can place that final order to manipulate price and push it up. Because now they've got that whatever, however big their trade is, $1 million worth of Australian dollars to sell, and then, basically taking the other side of the Canada trade. They're buying Australian dollars in this example because we're getting a bullish setup. So they want to do that. Accumulation, accumulation, accumulation. Like you and me, retail traders, just people on our laptops at home. We're not trading millions of dollars. We've got small accounts relative to the big banks, so we can just get in and out wherever. That's what I love about the forex market, foreign currency market. It's super liquid, but as liquid as it is, and it is the largest asset that's traded in the world markets. I mean, I don't know what the number is. It's up to like 8 trillion or 9 trillion dollars, equivalents of US dollars. 8 trillion, 9 trillion dollars of currencies are changing hands every single day. Every single day. And that's more than all the other markets combined. Stock market, futures, everything. Huge market. So that's why the banks love to trade in the Forex market, because there's so much money to be made. But even so, even though it's so liquid, they have to still accumulate their shares. They know that they want to take this market long. So they're doing a lot of buying down here, buy, and then they can actually push price forward. And then that's where this process just repeats. They're accumulating, they're pushing price up, they're selling into this area, sell, 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 sell. And then now they're starting to accumulate on the short side, sell, 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 and then ultimately manipulate the market. So, excuse me, mouth got dry. So I hope that makes sense. I don't know, that might be a good explanation. Maybe that's not. Tell me what you think, but yeah, it's really just a big game of cat and mouse. That's what trading is. Anybody that tells you otherwise is fooling themselves, or they don't know what the hell they're talking about. But they have to use retail liquidity in order to get what the hell they want. This is why retail traders matter. And they love us. They screw us, but they love us because they know they ultimately need us in order to make all their money. So that's it. That's a little bit about market structure. I'm gonna go take some cough syrup. If you have any thoughts or questions on that, let me know. Happy Friday. Have a good one.